This is Building Lifestyles, a show designed to help everyday Australians create a lifestyle that inspires them using property development strategies. On the show, you'll hear from everyday people changing their lives doing property development. You'll learn from their successes as well as some of the challenges they've faced along the way. We also talk to experts from a range of fields who share specialised techniques that you can use to accelerate your property journey. I'm your host, Amanda McEwen, and I'm the founder of The Rising Star Developer. And I'm really passionate about helping everyday Australians build lifestyle using property development. Welcome to Building Lifestyles. I have an exciting podcast for you today. Today, I'm going to be introducing you to Kathy from Ink Wealth. Now, one of the many questions that I get as part of property development is around finance and money. So I thought it was really timely, especially in June as we're heading into the new financial year, to bring a finance specialist into the podcast. So welcome, Kathy.
Thank you so much. Thank you so much, Amanda, and lovely to be here and helping out all of your participants or your inner circle, as you call them.
Thank you. So let's have a start, because there's always a bit of a confusion around the term of mortgage broker, finance broker. Can you just start off just perhaps letting us know the difference between the two?
Well, I don't really think there's any difference between the two. If I had to clarify it, I would say that a mortgage broker just specializes in doing, say, residential lending. Yeah. A finance broker is probably more over commercial lending, business finance, and development funding. So they're probably a little bit more specialized, but the terms are a little bit interchangeable.
Amazing. So certainly when I'm speaking to my community and my inner circle group, a good finance broker that has experience in property development is a really key part of your A team. So what would you see being the main difference between perhaps a standard mortgage broker who just does residential funding compared to somebody who actually does have experience in funding developments?
Okay, so funding developments is a whole different ball game to residential finance, and really does need a lot of experience and time in the industry. So I highly recommend that if you're looking to do a development, that you do seek a mortgage broker that's been in the industry for, say, 5 years plus as a minimum, because even within 5 years, they're still learning the ropes on residential finance and even just standard commercial finance. So somebody that's been in the industry has a lot of experience and has a lot of contacts, because that's really important as well. For small development, it's what contacts we've got that we can reach out to get the funding over the line for you.
Yeah, absolutely. And it's a conversation that I have with many, many people, because I have many people in the community who may have a relationship directly with the bank, and they'll go, I'll go and speak to my private banker at one of the big four and understand my borrowing power. And I'm really, really passionate and highly recommend having a great finance broker on your team. What is the main difference? Like, why would someone go to a finance broker versus just going to see their private banker?
So really good question. So there's a massive difference with just walking into a bank and seeing a mortgage broker. So a bank will only be able to sell you their products and their policy. So every bank, between the major banks through to the second tier lendings, they've got amazingly different policy, and that's our job to understand all that policy. And that is an absolute labyrinth for a client to try and understand. It's just impossible. And so if you walk into a bank, I describe it as it's like going shopping and only being able to walk down one shopping aisle. So you don't know what else is out there. There's a whole lot of other options that may be better for you in all the other aisles, but you've only been able to shop in one aisle. And often if you get a no from your major bank, because they are so strict with development funding, you may think that that's a dead deal for you, whereas there's so many other options available. So, I mean, certainly you could reach out to your bank manager as a starter and have a crack, but I would always recommend a finance broker, because we don't only have the major banks on our panels. We've got all the second tier lenders that do full doc and low doc, and they act in the space of basically approving loans for clients that weren't approved by the big banks. And then we've got all the private funders that specialise in small to medium development funding. So, yes, you could try with your bank manager, but please don't get discouraged if there's a no, because there's like hundreds of other options out there that will get you a yes.
Yeah, and you raise a couple of really good points there, Kathy, because what most people don't realise is that every bank has its own credit policies within the bank. So one bank, for example, might have too many developments on its books. So their credit department have suddenly said, okay, we're not taking any more developments here. We're going to move to just investment or just straight home lending. And as you know, as a developer, you don't always get exposure to that. So because we're not in there always looking for finance and always speaking to banks. So you're right, if you go there, you are just going down one aisle. And that's I think one of the key benefits as a developer that I have experienced in the past, because you guys are living and breathing. You're talking to banks, multiple banks every single day, and really getting a good insight into every single bank's policy. So even though one bank may not have a policy right now, and I think that's one of the really valuable things about having a finance broker on your team, because you guys are having conversations every single day with multiple different banks, both the majors and the smaller tier banks, and you're hearing what's going on. So if you're only speaking to your particular bank, you're only getting one opinion. And I see this time and time again where developers get really disheartened because the bank said no to them. They think their whole dreams about being a property developer are just gone. But it's only if they had the right.
And you're very likely to get a no from the big banks as well. So you're more likely to get a no from them than any other lender. It does depend on the size of the deal and what you want to do. But so we've got updates coming in via email from all our different lenders daily, and we have direct access. So within every lender, including all our private bankers, we've got a person and a phone number and an email that we can literally pick up the phone and make a phone call to. Or, maybe we'll do a little bit of a bulk email out, and we don't put the client's name. We just say, hey, we've got this deal. This is the parameters. Does this look like a deal that you guys can place? 2 or 3 will come back and go, yep, that looks fine. Then we start to progress further with some finer details. So we can really put it out there to a lot more lenders, and we've got sort of that direct contact. And we'll probably tap on this a little bit later, but it depends on what the deal is as to where we look to put the loan. And that's the strategy that I love doing, and that most experienced mortgage brokers, we start to love the strategy of the deal. It's not just about a home loan anymore. It's about where we're going to put this. It's forward thinking of what you want to do with the next step. It's not let's put it with XYZ now. We're planning for your investment future and making sure that we're placing it with the right lender. So that strategy and that experience is very, very important. Yeah.
Absolutely. And given that money and funding your deal is such the enabler to actually even getting into a deal, that strategy that finance brokers like yourself provide is the difference between getting into a deal and not. So that's why, regardless, when you're building your A team, it's so important to be working with brokers and people that have got experience in broking, but also understand property development as well, because it is different to normal buying a standard home, and that's where the value pays for itself time and time again.
Yeah, it really does. And just building those contacts up is invaluable as well. That you can just reach out to at a phone call. And understanding that when a deal comes across your desk, where it's likely to end up. Like for instance, if we're just building a duplex, we will try and put that with a sort of a first tier lender for you, because the interest rates are going to be low. You'll be able to leverage very high. You will be able to leverage up to say a 90%, 80 to 90% loan to value ratio. So if it's just a smaller deal, we will try and put it with the best and cheapest option where you can leverage the most of the bank's money first. Or then, as the deal gets more complex, we may need to move into the second tier lenders where their policy is a little bit more relaxed. Their rates and fees are a bit higher, but if it's going to get the deal over the line, that's what you need to do. And then as the deal gets a little bit more complex, we move into development funding. And development funding is where, you may not even need financials to complete the deal for development funding. It may all be based off the feasibility of the actual project. But the loan to value ratio, or what they'll lend against, changes as the risk increases on the deal. So if we're just lodging with a major bank for a duplex or four 2x2 duplexes, say for instance, the risk is pretty low. So we can put you with the majors, and the LVR, the loan, which I don't want to talk lingo here, that means loan to value ratio, guys. LVR, loan to value ratio. You may be able to leverage higher. And as the risk gets higher with the second tier lenders, the loan to value ratio may drop to 70%. And then as we move to development funding, where we're not even showing financials, we're just using the actual feasibility of the deal, and you're capitalising the interest, you don't even need to pay the interest, then, the policy is a whole different spectre once we move to development funding. It's completely different. But the loan to value ratio reduces down again. And so with each of that, you need to put in more of your own equity or more of your own cash, etc. And so that's what we analyse when we get a deal come across our table, like where do we think this is going to be best placed?
Yeah, and you raise a really good point there. And you call it development funding. Other people associate it with being as commercial funding as well. And it's a question that I get asked quite regularly. When people are starting out, they get really nervous about the thought of going into commercial funding versus residential funding. And the conversation I have with many people time and time again is don't fear commercial or development funding, because like you've just said, it can actually really open the doors. And yes, it may cost you more to do commercial or development funding, but it actually gives you so much more flexibility. And when you're building up your feasibilities, you just build all of those costs into your feasibility. And it can really be the difference between getting a deal across the line or not.
Yeah, that's right. And it really depends on, on your deals. So for instance, I've just got one that we're working on at the moment, which is very exciting. And it's an elderly couple. They're in New South Wales. They've been owning their property for quite some time, and they're now looking to put a block of 6 units on it. So when he came to me, I sort of assessed the deal and thought, we're not going to get this over the line with full doc because they're quite elderly and closer to retirement. So we're almost in the middle of getting this over the line with development funding. So because they had a lot of equity in that property, and they didn't have, they had a very small loan remaining on it. So because they had a lot of equity, we could just get it over the line with the development funding, and all the interest is capitalised on the loan, and it'll pay for the full construction amount. Now they are leaving that property; they're selling it, so they're not keeping any. They're selling it, so there's no end debt. And so it was a very straightforward deal based off the feasibility of the project. If you are keeping an end debt, I should just point out, if you are keeping one or two of the properties and there will be an end debt, then there's usually financials required where you just need to prove that you can refinance out that loan. Because what happens with development finance is that once you've finished with the development, if there is to be one or two properties left and any debt remaining, you've got to finance that out back to mainstream lending. And so they want to make sure that you can service to finance that out. They don't want to be stuck with you or having to sell properties because you can't afford the end project. So, but I probably jumped the gun a little bit too much there.
No, that's okay. No, it's great because and it's great. You mentioned about your clients that are venturing towards retirement. I think that's one thing that to impress upon people is there is no one size fits all when it comes to funding, is there? Because everyone's personal circumstances are so different financially, but also whether you're an employee or got your own business. And I've always seen this is where having a really great finance broker on your team is so important to help you navigate through all that and work out whether it's a low doc or whether you can go into or what sort of funding is going to be most suitable.
Options available, definitely. Yep. For with the second tiers, you can generally look at some low doc, and there's owner builder options available with the second tiers as well. If you walk into one of the majors and asked to do a project as an owner builder, you'll be walking out reasonably quick.
Absolutely.
Yeah.
So for people who are starting out and are just trying to get their head around development funding, if they're working with a broker like yourself, what sort of information should they start pulling together so that you can best assess what their borrowing power is? Because I think that's one of the first hurdles that a lot of people, when they're starting out, need to get over, to then even understand what their own financial capacity is.
Yes, it's true. So, I mean, finance is so crucial in the whole process of doing your development. Look, the first thing is just to reach out to a broker and initiate the conversation. So, but what we'll do then is we'll capture your goals and your needs, and we'll ask a few basic questions. Off the back of those basic questions, we'll probably send you a very short questionnaire to get some more detail on the project. And then we can kind of assess where we think your deal is going to be placed, like how big it is. Is it going to be mainstream? There's the mainstream residential type of lending for the smaller projects. Then you go to the mainstream commercial. Then we've also got the second tier lending, and then we've got the development. So really there's 4 types of lending that we assess when we're looking at a deal. And so we just reach out, start the conversation so that we can capture the deal. We will ask you for some details and a very sort of a brief fact find. Things that we'll ask for is where's the security property, financials, assets, liabilities. Have you done a feasibility study yet? Like, have you got a quantity surveyor's report yet? It depends how far down the track you are, obviously. And depends on how complex the deal is as well. If it's just a duplex, you don't need a quantity surveyor most of the time, etc. So reach out and start the conversation. Every finance broker is going to have their own process. Ours is to have an initial conversation, then we'll send you a form to fill out with some brief detail. We get your financials. Probably get a copy of your financials in, and then we'll sit down and kind of assess that before reaching back out to you and say, hey, we've had a little bit of a look and this is what we think, and we take it from there. And as you said, everybody's situation is so different, from PAYG to really complex self-employed that have got a couple of different companies to partnerships coming together. Somebody might not have the equity or the cash to do the deal, but they've brought on a sponsor to help them. So all of that is so individual to every deal that it's hard to answer in a cliche form of exactly what we need. So the first step is just to reach out, I think, and start the conversation.
Yeah, okay. And so in terms of timing, so if someone reaches out to you to get an idea of what their financial capacity is and they're quite new, how long does it actually tend to take between when they first engage with you to then get a feel for what their actual borrowing capacity may be to do a deal?
Okay, that's not a straightforward question either, because, we could have a really complex deal where we're reaching out to the development funders, and we might reach out to 5 or 6 of them, and we're waiting for all their answers to come back. It can also be dependent on the client providing us with the documentation so that we can do the review. Generally, once we get a lead through, we'll pick up the phone and make an appointment with myself. Louise from our office will make an appointment with myself. I'll reach out and do that first conversation where I really understand the deal and get your goals and a picture for what the client's trying to do. Then we'll send them a list of documents that we need and a snapshot of the deal that they're putting together. That's when we then will put aside, depending on the complexity, we may need to put aside a half a day to a day to actually review that and really make some inroads on that. If we understand the deal enough and we have a feel for it, we'll then reach out to our lenders straight away and see what's possible. If it's a really basic deal like a duplex or a 3, even a 4, and we're thinking that we're going to put them with mainstream lending, we need a couple of days to work on the financials and do a preliminary assessment. So the preliminary assessment is quite detailed. We get back to them with, look, this is how much you can borrow. This is how much savings or equity you will need to complete this deal, including the costs in the middle for your town planner and the engineer reports and the surveyor, etc., any of the water costs. So we kind of add that into our preliminary, and we say, look, we think it's possible for you to buy a property worth $1 million, and we think it's possible for you to do that duplex that you should be able to build for, say, 800,000. And you've covered the equity, the savings, etc., and the servicing, and this is the bank we recommend. So that's quite a complex preliminary assessment, and that. Look, I would say for a deal like that, from initial contact point, probably a week.
Yeah.
So it's best to reach out early. Like, don't think that a broker is just sitting there waiting for your phone call.
You busy
We've
people?
generally got a few things happening on the side, okay? So we're pretty busy. So you do need to allow us time to actually focus on your deal. So reach out early, don't wait for the last minute. In saying that, I've had 3 clients ring me yesterday and say that they've found properties. We've got no preliminary assessment done, no pre-approval, anything. So that kind of hijacks your day and you've just got to jump into it. So that happens. That always happens. But if you can help it, reach out early and give your broker time to do the assessment properly. Yep.
Yeah, that's certainly great advice. So what, with the clients you've seen in the past, what have been common challenges or pitfalls that you've come across that have really held people back from being able to get the funding they need?
Yeah, okay. So to get the funding you need, okay, the first thing that you really need to nurture if you're moving into being a property developer is your credit file. So the credit file is generally the first thing that the majors and even the second tier lenders will look at, just to make sure that there's no, bankruptcy or really large unpaid debts on there. So anything you're doing with finance, and if you're moving into the industry where you're going to start asking for finance all the time, and even just homeowners or investors, your credit file is the first thing you need to make sure it's got no marks on it. So pay all your bills on time, pay your mortgages on time. They can see now whether if you haven't paid your mortgage for a month and you play catch up and you only pay it the next month, it'll have a 1 on your credit file now against that loan. Let's say you've got a loan with Westpac. You'll have a 1 against that month to show that you missed that month. You're at 1 month late. Well, the banks don't like that at all. So that could be the difference between the bank approving the loan or not. So just start to nurture that. You can get a free copy of your credit file. It's on Equifax or My Credit File. It's a very basic report, but you can get a copy. I would say the second pitfall is you need to have enough equity to do this deal. As a minimum, you really need to have, if it's just even if you leverage as high as you can for a smaller deal, you can go up to 90%. So as a need that that includes the lender's mortgage insurance fee, which is another whole thing. We won't go into that. Look, as a minimum, I'd say you need 20% deposit for the initial purchase of the property, and you should be prepared to have 20% to put into the construction loan, because if you're moving that project ahead as quickly as you can, you may not have had a lot of growth in the property. So therefore, you're going to need the 20% for the initial purchase and 20% to contribute to the construction, plus 50 to 70, approximately for a smaller deal, for your costs to get the all the plans drawn up and all the reports done. So 20% as a minimum. If you're looking for anything larger than that, and we're going to the second tier or the private funding, you really need 30 to 40% equity. So where's that equity coming from? Is it equity that you've got in a property? Which equity in a property is good, but if we're pulling that out as a loan, you need to service for that too. So we work, depending on your scenario, we figure all that out. If you've got a line of credit or a cash and it's already sitting there, fabulous. Or, if you've got investments that you're downselling, or have you got an equity partner or a sponsor that's coming in with the cash? So that equity is super important. You can't do the deal without figuring that part out. And the second, what would be the third most important thing? Making sure that you've done your due diligence prior, and making sure that you've done your homework with doing your course, Amanda. And that even comes, if I'm lodging an application and I can say that they've completed a 6-month course, they're not just, winging this. They've completed a 6-month course and they know what they're doing. They've already got a feasibility study. They've got the templates for that. They've approached a town planner and found out whether it's possible. All of that weighs in on a yes for the client. So doing their due diligence and making sure that they've run the figures, like do a little bit of it. I can help you, certainly, and that's what we do. But you should have done a little bit of your own figures as well.
Yeah, absolutely. And so, and you raised a good point there. So when I'm teaching my students about getting themselves ready to do a deal, first thing has been the feasibility, making sure that you can the deal is viable. If you've actually found a deal and you wanted to get funding, this is prior to if you just wanted to know your borrowing power. But what I also do is I give students my information memorandum template, which really, if you have a deal, it captures the feasibility, but it also shows you've done your research and know what you can and can't do on the site. You've done your research into the end sales prices. So even if you haven't done a deal right, being able to
Yes.
go to a broker or a bank and say, hey guys, here's my information memorandum, here's my deal, I can actually do what I want to do on it, here's some comparable sales, here's my feasibility showing what profitability is, and I'm getting supported by somebody who's got years of experience and done, over 66, built 66 houses and what have you.
Exactly. Yep.
That's a very different conversation to have with a finance broker and a bank than if you're going in cold and going, oh, I'm not sure what I need. I don't quite even understand the difference between debt and equity to do a deal. And that is really the power of being able to invest in yourself and getting support from an educator, but also a broker like yourself to be able to help put the pieces of the puzzle together to put your case in front of a financer in the best light possible.
Yes. And I'll just also add to that. Sometimes if you're doing one of the smaller developments, obviously if you're doing a larger one, you absolutely have to have your feasibility study and you need to have a whole lot more information gathered. If you're just looking to do, buy a property that has a house on it, subdivide it and build a duplex or one down the back, and you may even have a buyer's agent that's going to help you find that suitable property, then you don't need to have a lot of information, because then it's really up to me just to say, this is the maximum purchase price we think this is your maximum lending capacity. This has to include the purchase of the land and your construction costs. And off the savings or equity that you've told us you've got, this is your maximum purchase price. So we kind of then let them go to the buyer's agent or out to market with what they can, what's possible. So if it's just a smaller deal, they don't have to have a lot of things completed as we've just mentioned. But if it's a larger one, yes, they do.
Yeah, for sure. So that's certainly if you're doing a development, you want that information. If you're doing a simple land split, like you mentioned, a simple land subdivision where you're just buying a block of land, bulldozing it, splitting it into 2 or 3, you can certainly you go a lot simpler, and you'd go with very simple residential funding for that as well. And these are the conversations you'll have, right? So the first place to start is always engage a finance broker and just understand what your line in the sand is in terms of how much you have access to even do a deal. And it may come back, right, that you may want to have $500,000 a mil or $2 million to be able to do a deal, and then you get the news back that perhaps you don't have as much as you'd like. That doesn't mean that your goals of doing development are completely gone. It just means that you then need to open your mind to other ways of being able to fund your deal, whether that's using money partners or investors to be able to then provide whatever it is that you don't have. And that's certainly been the enabler in terms of how I've been able to scale my business. But it's the same with a lot of people around you, or students around me as well. But that's the conversations to be having. We firstly start off with understanding our borrowing capacity and having conversations with Kathy and her team there to be able to find that out. Once you know that, then you can go shopping, find your deal, and then use multiple different strategies to then get your deal funded. And that then involves engaging, once you've found a deal, then having that next level of conversation with your broker to get that deal funded.
Yep, so true. So it just allows you to pivot if you need to, or go looking for a sponsor or it is usually useful to still have a day job, by the way, with when you're doing the small development. I mean, obviously you still need a service for the loan. So a desk job is what's going to get you that loan for the small development. If you don't have a desk job, then you're definitely looking at development funding, which is possible. You just need a lot of equity.
Yeah, certainly. And one thing that I impress upon my students is I say, don't leave your day job until you've banked at least 2 times your income, because you do need that serviceability. Unless you're using a money partner to provide your borrowing, you need that for serviceability. But then you also want to make sure you've got income coming in while you're building your whole property development business to be able to keep the roof over your head and food on the table, which is really, really important. So I have a very strong focus on managing risk. And for me, having a great broker on my team is a key strategy around managing that risk, so that I know that I can always get funding for my deals. And I personally always have conversations with my broker on a regular basis going, okay, well, I'm looking to do a deal in X amount of time. How are things looking from a finance perspective, just to understand where the market's at too, because you're on the front line, right? So you're hearing what's happening in the market.
And it's changing. Oh my gosh, it's so hard to keep up with. The policy and the bank is changing daily.
Yeah, it's crazy, isn't it? So how do finance brokers get paid? Because it is different when you're dealing with residential funding compared to development funding. Can you just share with the listeners what the difference is between that, so they're clear about what costs may be involved? We don't get specific on cost, but just so they understand how you get paid and when they work with a broker.
So a finance broker gets paid by the bank if it's a normal first-tier lender or second-tier lender. We get paid by the bank for doing all the work up front. So we submit everything. We've already done all the scenario. We've ID'd the client, qualified their lending, sent all the documents in. On settlement of the loan, we get paid a commission from the bank. It's called an upfront payment. That upfront payment, if we close that loan down, or if the loan is closed down within 18 months, we get that upfront payment clawed back from us. That's actually our industry terminology. It's called clawed back. So basically, if you purchase a property and you do your development and you sell it within a year and a half, we've made no money. So it gets clawed back from us. So and if with development funding, it's different. They don't pay us a commission. We get an engagement fee or a mandate fee from the client. So what we do is when we're working with our developers and we know that there's every possibility that they're going to close the loan down within 18 months, we mandate a fee, and this is for the simple ones. This is for like 2 to 6. When we're talking the bigger development deals, our mandate fee will vary depending on the complexity of the deal. If it's a reasonably straightforward deal, we will ask for that commission off the client upfront. So before the loan settles, you need to pay us what our commission would be. If that loan is still in place in 12 months' time, because the banks actually take back 100% at 12 months, and then they take back the rest of they'll only take 50% back at 18 months. So what we do is if that loan is still in place within 18 months, say, we refund, and then there's no clawback, we refund that back to the client. So we just need to, and any broker that does development finance is the same. So basically we need to make sure that we're being paid for the work that we do. And for the development finance, there's so much more work than a normal residential. There really is. We really do nurture the client through the whole process. We strategize with them where we're going to place them up front, and then we're holding their hand throughout the whole process of all the construction loans, the consent to subdivide. So there's a lot more work involved. So we do have an upfront engagement fee to do the assessment for you. And then for our commission on the actual loan, we will ask for that upfront, but it's 100% refunded if the loan isn't closed down and we don't get any clawback. So that's the way it works for just the normal resi lending or even second tier lending. If you're going to development funding, that's we don't get paid anything by the bank, and that depends on the complexity of it. And we will judge that, and we will generally set a mandate fee for our work and our time on that project.
Yeah, and the reason why I asked that question, I think it's really important for developers to understand the costs that are involved in funding your deal, because most people, when they've used a broker, they've bought their own home and they don't see a lot of fees. They think, okay, well, this person's worked for free, and they don't see the costs that are involved because that's being paid by the bank. The banks are effectively using brokers as their business development team. But it's very different in development, because you're generally in and out in a project within a certain period of time. Yeah. And I believe there's enough money in property development for everybody to get their piece of the pie for their work that they've done. So it's always worthwhile having a conversation with your broker up front when you're looking at doing a deal to get a feel for what those costs will be. And they're generally, when you're doing a development deal, they're going to be in the thousands, but then you factor that into your feasibility, and that just becomes the cost of doing business. So have those conversations with your broker when you have a deal to understand what those likely costs may be, and then you just build those into your feasibility. So it makes sure that after all the costs that are being paid for your finance, that your deal is still profitable and it's worthwhile going ahead. So this is where it's really, really important to have a great relationship with your broker and any of your A team, really, because it's not just a one-off transaction. You are working with them throughout, from right at the very beginning, understanding your borrowing power, but then also when you've got your deal, getting your land funding for the raw site, and then when you're refinancing for your construction funding, and then each of the progress claims as well. So there is a lot of work that's involved from a finance broker to support you in that capacity. So have those conversations early.
I was about to say, it's just doing a normal residential home loan or a refinance. To do a development and a construction, it's at least double the amount of work required from the broker. So they're going to want to make sure that they're going to be paid, and that they're not relying on you to say, oh, look, it should be 12 months or it should be 18 months. Look, that's fine. We'll get paid up front and we'll refund that to you if it does, if the project does go beyond that timeline. But so exactly. So they just incorporate that into their cost, and they're happy to have, because we are kind of the linchpin in between the middle. We really are connecting the client with the lender, and we are keeping the lender honest too. So we generally save you money with that as well. If you just go in to any, small to medium private lender, you don't know whether the rate that they've quoted you, they've seen you coming, and the rate that they've quoted you is outrageous. So we are the ones that keep them honest and, get you a good deal. So it's generally well worth your time.
Absolutely. I couldn't agree with you more. Now, you've worked with many developers over the years. I'd love to know, perhaps even your top three, what are 3 things that really good developers do well that enables you to do your job well, and to keep that whole process between getting your funding so much more easier and streamlined? Do you have any tips that you can share with the listeners?
Developers that know what they're doing, they will come to me with an outline of the project straight away. So they will generally have already done a feasibility. They will let me know where their equity and their cash savings is coming from. So they've already got their own little template that they've pretty much filled out for me. First-time developers are not meant to know this, and we understand that. We've got our own template we can send you. But they come to us with all the information up front. The other thing they understand is that there's a lot of documentation required in getting these loans over the line. For development or construction, and development's even more than just a smaller construction when you're doing larger, it's not just the documents for the financials and the assets, liabilities and the ID and things like that. There's the quantity surveyor's report. You might need information on a builder. And I'll just throw in here while we're talking, some of the development funding really rely on what builder are you contracting as well, and it can help your opportunity to get a yes from a development funder if you've had a builder with a lot of experience. And some of them will in fact ask for information about the builder and past experience of the builder. So they realise that there's a lot of documentation required. That is probably the worst job that you as a developer need to do for me or to get your funding is to provide the list of documentation. And the sooner that you accept that and just sort of march on with it, the easier it is. So they understand the documentation trail as well. Yeah,
and the first time is always going to be the most challenging while you navigate through all this documentation and you're not quite sure what comes next. And I think as when you're managing a project, you've just got to keep on top of it and keep pushing through and moving through it. Otherwise, if you sit on this documentation for 2 to 3 to 4 weeks, that's then going to flow on to you actually getting to site and starting to build, and ultimately you're getting paid at the end. So it is part of doing business, and it doesn't take a lot of time, but it's just one of those things that you have to do, isn't it, to be able to enable you to be able to get the funding.
And dedicate the time. And we often liaise directly with clients, accountants, and if we need financials, you just send an e-introduction to your accountant, and we ask them, we talk the talk with the accountant, and they can flick us off all the PDFs that we need in about 1 minute, rather than the client often hunting through their files and trying to photocopy the last 2 years' financials. So, we can try and make it as easy as possible.
And you raised a point about accountants. Do you think it's worthwhile that the person who's engaging you has had a chat with their accountant first to understand if they are going to head down this development path, what's the best structure for them? Does that actually affect how you're going to secure funding?
I don't think it affects funding unless it gets larger. If you're just doing, it doesn't matter whether you're putting in a company or a personal name for the smaller developments. And the banks generally lend the same, whether it's in a company or a trust or in your personal names. There's the loan to value ratio, or LVR, is generally the same. So it doesn't for the smaller developments. I think if you're doing a bigger development and it's pretty serious, much more serious stuff that you're looking at, yes, that's a conversation that you should have definitely had, just about all things development. This is what I'm looking at doing. Obviously I'm going to be paying GST on all of this. Should I be putting it in a company with just myself for asset protection, or both of us? Or I think, and depending whether you've got another business partner coming in. So if it's a smaller deal, it doesn't matter initially for us to do the preliminary assessment for you. You can make that decision right up to signing a contract. It doesn't take long to set up a company and an ABN.
No, very quick.
But maybe for the bigger deal, that is definitely a conversation you should engage. Yeah, I would.
Yeah, no, that's great. Now, can we just let the listeners know you're based in New South Wales, but you've got connections all around. So you can people from all different states engage Inkwell to be able to help them with their financing?
Yes, my database is national, and our lenders are national. So it doesn't matter what bank it is, they're lending nationally, and my clients are all around Australia. So absolutely, I don't even have that many face-to-face appointments, even with my local clients anymore. Everything now is done. I ID clients over a video ID, or over a quick app. So everything's really is via email and video these days. So yep, definitely doesn't matter.
Amazing. So if people want to actually start getting their assessment, their initial borrowing power worked out, what's the best way for them to be able to do that?
Okay, so reach out to me. I'll give you my email, and I'm sure you can probably put this up as well, Amanda. So it's Poppy with a K at inkwealth.com.au, or you can go onto our website. However, I do have a special handout for you. So if you want the special handout, you just need to go to inkwealth.com.au/development checklist. So if you go to that link, we do have a little handout for you, and there's also a second little gift in there for them as well. So there'll be 2 handouts for them if they go to that link.
Oh, that's amazing. And we'll put all this in the show notes as well, so people listening to this can easily go there and access that. And any sort of checklist like that is so helpful when you're starting out. So thank you so much for sharing your experience and your insight. Finance is such a key part of property development, and just by what people are going to learn from this podcast is going to help that very first step of understanding where to go and where to start so much easier. So thank you so much for your time, and I look forward to...
Thank you very much for having me.
Pleasure anytime, and look forward to helping people in the community really get over that first hurdle to understand their borrowing power and moving ahead.
I look forward to helping anybody that reaches out. Thanks so much, Amanda. Thank you, everybody. Take care.
Thank you so much. Bye for now. Thank you so much for listening. This is Building Lifestyles, a show designed to help everyday Australians create a lifestyle that inspires them using property development strategies. This podcast was produced by the Rising Star Developer. We've been helping Australians realise their financial and lifestyle goals since 2020. We play a pivotal role in educating, supporting and celebrating the goals and successes of our students and our community. To find out how we can help you realise your property, wealth and lifestyle goals, head to our website www.risingstardeveloper.com.au. To make sure you don't miss an episode of Building Lifestyles, be sure to subscribe to and follow the show in your favourite podcast app. And while you're there, leave us a 5-star review, as it really helps others find the show. I'm Amanda McEwen, and we'll be back next episode with more tips on how you can build your lifestyle.